To me, I am looking at, in terms of signals anyway, I am looking at a market that is seeing massive, and I mean massive, deliveries, Daryl, into COMEX. To me, first and foremost, above all else, that's really what matters, because what you are witnessing are the most well-informed traders in the world. Forget about the fact that we're seeing billions and billions and billions and billions come into the market, into COMEX every single month, which no one's talking about on the mainstream, which I just don't get. But the people at that level who have that kind of wealth, they're also connected to the information. They're not doing it just for the hell of it. These people are at the highest level of government, at the highest level of finance and of influence. And when we see what amounts to literally billions every single month coming in, to me, that signals not only that the metal itself is probably worth more than the money being used to purchase it, but it also signals to me that it is a physical delivery that is, I guess you could say, there's a fight going on over real delivery demand over paper promises. And I'll give you an example of what I mean. Now, this is what I'm about to tell you is true of everything we've seen every month since a year ago, November, when Trump won the election. But in the month of December, there was 3,706,000 ounces of gold delivered on COMEX. Well, 3,706,000 times, at the time, $4,300 an ounce. Do the math. You're at, $13-14 billion. And how about the 64,730,000 troy ounces of silver stopped and issued and stopped? That's the same thing as delivered. What's 65 million ounces of silver worth at $80 an ounce? And if a mint box of silver maples or eagles weighs 42 pounds, what does 65 million ounces weigh? And at this level, it's not even the money, Daryl, as much as it is the information that is pushing these people to do it. Now, this has gone on again. Here we are in January, and we've seen roughly 6 or 7 days on the delivery month, which is not a major scheduled delivery month, and yet we've already seen in silver almost 7,000 contracts stand for delivery. About pretty damn close to 35 million ounces of silver has already been delivered in January. So between December and January, you have 100 million ounces of silver that has stood for delivery. Now there's still another 2 weeks left in the January contract, but this has been going on every single month. And I've been screaming about it on a central bank level since 2020. You go back and watch any of the 6,000 videos I did in that time frame, and you will see this has been a primary thesis of mine, that when the most well-funded and well-informed traders on the planet take possession and remove counterparty risk, stand for delivery at these kinds of numbers, which we've never seen this before on COMEX. Never. And where is the mainstream media with any journalistic integrity at all? Where is the idiot Jim Cramer? Where are all of these people who are supposedly doing what's right by the people that they're talking to, and instead they're leading them like the sheep to slaughter? This, to me, is all you need to know. Yes, on top of it, the United States government classified silver a critical mineral. Geez, do you think the U.S. government could maybe be taking possession of 100 million ounces of silver? I don't know. Sure seems that way to me. And forget about the fact that the European Union did it a year ago, and forget about the fact that China, everyone talks about them tightening the noose on exports. Well, what people don't really talk about is what they said in November, which is that we are prioritizing silver for domestic needs before anything else. Then they put on the export restrictions, and they're responsible for refining 70% of the world's silver doré. Yeah, things are getting very interesting. But in terms of the noise and the periphery, what else do you need to know? But that the biggest money in the world who knows the information actually probably creates the information, or is real close with those that do, says, yeah, let's stand for possession every month of billions and billions and billions. And shh, don't tell anyone. I have to look over my back and make sure, I don't got someone looking to stab a knife in my shoulder, because I've been saying this for months on end now, and it's happening, and it's accelerating. December was the biggest delivery ever in silver, ever, for a month of December in the history of the COMEX market, which goes back to 1974. So,
Wow.
I don't know, man. Things are starting to get crazy.
Yeah. So I'm curious obviously there's many reasons why, but is this like a signal of like the global economy cracking, losing significant value with the de-dollarization and such? Like, just curious, and like, why are these, big institutions? Obviously we've had the central banks, and we've covered like, them buying because of, sanctions and the dollar
Right.
being weaponized and such. But
Right.
now you have like bigger institutions, or, even wealthy investors that are demanding delivery of that metal. Just curious in the why.
Well, I think that's fine, and you're right. Um, all of those things matter. The U.S. moving silver into the critical minerals list, and putting frame silver as a national security issue, not a collectible metal issue. What you basically have is a situation where the paper price and the physical reality are on a collision course. And central banks, as you mentioned, have been buying largely because of no counterparty risk. And the fact that it has outperformed, both gold and silver have outperformed just about everything. Gold, going back 25 years, has doubled the 10-year Treasury, has no counterparty risk. Look at it over the last few years. 2 years ago, gold up 45%, the 10-year Treasury up 4.5%. That's 10 times a gain, no counterparty risk. Last year, gold up 80%, the 10-year Treasury up 4. That's 20 times, no counterparty risk. Look at it, where we are at silver. Silver up 150%, 10-year Treasury up 4. I think what you are seeing is the fact that it's an issue of trust. People don't trust. Not only do they not trust really the institutions that are issuing the treasuries and the government standing behind it, who, to your point, can sanction, but it's also a lack of trust, I think, in the markets. And, I think in essence what you are seeing is the fact that these entities who understand where this is all going would rather have the real physical metal instead of paper promises. Yeah, 100%. And when you see these kind of deliveries instead of paper promises, when you see countries standing to change the rules by implementing strategic minerals lists or tightening exports, this is becoming real very quickly. When we started the year 2025, silver went from the mid 20s, low 30s early in the year to upper 70s by year end, and now we're trading at almost 90. This is not, and as far as I'm concerned, this isn't just a gradual rise in the price of silver. This is silver repricing, and gold repricing, which doubled. And I think these things are beginning to happen. And it's because that there has been, for many years, central bank suppression on both gold and silver in the West. Silver for the military-industrial complex, and gold because of Gibson's paradox, the inverse relationship between real interest rates and gold. So they had a vested interest, they being the Western elite, the central banks, in holding these things down. What makes things very different now than at any time I've ever done this is the ability to stand for delivery. And the countries that are doing so prior to whoever's doing it here in the U.S., these were, I think countries that for many years were not sophisticated or coordinated or motivated or had any interest in challenging the West. And they're doing it now by standing for delivery, which is a completely legal thing to do. And when you have exchanges that rehypothecate, in other words, sell the same contract over and over and over again, creating tons of volume and extra cash and the ability to, in essence, fleece the market because no one stands for delivery, it's easy to do. But when everyone says, here's the vulnerability in the entire system, and it's about standing for delivery. It's like Bernie Madoff. Everyone was happy with Bernie making big monthly checks until they said, but we want our principal back. And then the whole thing fell apart. Well, it's the same thing here. It's the vulnerability to the Western system that has been exposed by countries that are coordinated and motivated and wealthy and sophisticated that were third world 20 years ago. Now they're not. And this is creating a very, very big problem. Anyone foolish enough to be naked short in this market, I think, deserves what they get. And I honestly believe that we will find that out sooner than later, as some of these banks are hemorrhaging. And there's a report out of the Economic Times that says it's the U.S. banks that are long, and that and they have quietly flip-flopped, leaving the European banks and maybe a bank or two in Canada naked, exposed to what could be an existential threat in the rise of metals prices. And anyone that doesn't think that's possible, I would urge them to watch the YouTube video that was done between Bart Chilton and Andrew Maguire, and the same thing between Bart Chilton and Chris Marcus, Arcadia Economics, when he spoke of Bear Stearns going bankrupt largely because of them being on the wrong side of the largest paper short in the world. And it went against them from 9 to 21. And that is one of the craziest interviews I've ever seen in my career. I think it's one of the one or two biggest, most important interviews you can ever watch. If you own metals, you're on the wrong side of this trade to the level that these Western banks are. And it is an existential threat when prices are moving the way they are because of standing delivery requests by not only, whoever's doing it here in the States, very sophisticated money, but also the central banks around the globe.
Mm-hmm. Got it.
George and his team, a 16-year Barrick employee building some of the largest mining operations on the planet. We started a drill campaign. From the drill campaign, moving into a full engineering report and study. We came out with our pre-feasibility study in 2021, and it showed a really impressive economic case for advancing the project. We'll have final definitive feasibility out in December of this year. So in the space of 4 years, fully engineered, fully permitted. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
A couple of things I'm curious in your perspective on. So, obviously people are buying metals because of the loss of confidence and the loss of trust, which is very different than those that are buying metals for the industrial demand. And I'm just curious in your perspective on the weight of both of those. I mean, because it seems like the loss of confidence would drive a lot more buyers into these markets. And I think that, I don't know your assessment of like the public, the American public, or, the average Joe and Jane in their buying of the metals. But, if there's a confidence issue, I'm sure they would come screaming. And I've seen some videos of like some lines super long outside of like metals dealers and people wanting to buy metals in other countries. But, just curious in your take on the loss of confidence versus that industrial demand.
Well, I think the public will be last to the party. The industrial demand, I think, will come to some sort of a very large battle with the big funds, the big money that's doing it from an investment standpoint. Who will have a very hard time ignoring the gains that we're seeing in these markets that are blowing through all, resistance levels and have outperformed everything. So at some point, ask yourself who stood for delivery for 38 million ounces in the last week on COMEX, and who stood for delivery for almost 70 million ounces last month. And is it the federal government? Is it Tesla, Samsung? We already heard how Samsung's gone to Mexico and dealt directly with the mine by buying doré and concentrate. But that's the same thing I've been saying for 2 years now that China's been doing, as I was told by Sean Kuhn, a mutual friend of ours, the CEO of Dolly Varden, and Keith Neumeyer talks about it, how how China is going directly to Mexico, the number one producer, China's two, and to Peru, the number three producer, and buying all their pre-refined silver in the form of doré and concentrate, paying double what the West will, shipping it back to China to refine it. Well, that's the exact same thing that Samsung is now doing. So you're seeing a situation where at some point the industrials who have to stockpile say, my God, it's going so fast and now everyone's going to buy it. If we don't jump in and take millions of ounces, we could be in big trouble. So you will see the industrials battle I believe, the hedge funds at some point and push the price massively higher. At the same time, now you have the governments involved as a critical mineral and limiting exports. And there are very few commodities that have plurality in use, right? Like you have monetary, you have military, you have industrial and many forms of industrial. And you have all the players in that game that are all saying, well, geez, I need it. And now you have the U.S. government amongst the European Union and now China, the real big boys and girls in the room who are saying, but we need it too. And so between the industrials, the governments, the investors, and then the retail investors who will get the scraps into a depleting pool of availability, where we're now 6 years in a row in a structural imbalance between supply and demand. Only about, 18% of what was mined last year, of the 800 million ounces, only about 160 million of the 800 million came from companies mining silver. That's it. The rest of it, and less than that, comes from byproduct mining of copper, lead, and zinc. And so, yeah, it's becoming something where demand is massively increasing, hasn't hit the mainstream yet for the retail public, but it's being driven by the highest money in the world at a period of time when we're going deeper and deeper and deeper into an imbalance between supply and demand. Mm-hmm. And it's coming out of the ground at 7-1. In other words, 7 ounces of silver for every 1 ounce of gold, yet it's still priced at upper 50s, 56-1, but it was at 120-1 in March of 2020. It was at 85 or 90-1 most of the last several years. So it's beginning to move back towards not only its historical ratio, and everything always does regress to the mean, regress to the average. How low does it go? Don't know. But if you told me that it would regress into 30-ish to 1 or 20-ish to 1, I mean, that's totally logical and still many times higher than it's being pulled out of the ground at and depleting, disappearing. So you look at all the silver used in military applications and industrial applications, and the military applications have blown up, and the industrial applications, because such a small amount is used, most of it doesn't get recycled. It's in landfills. So it's depleting, it's disappearing, it has multiple uses, and now being challenged by sovereign nations. It's, I think, the buy of a generation.
Yeah, for sure. So a couple things. So obviously, you have these competing forces for, scarce metals, right? And some folks are buying this. Some institutions may be buying this for investment purposes, but some people are buying it because they're like, okay, I need to protect my capital. I need insurance. So if we look at, the trajectory right now, there's some narratives that the Trump administration and the Fed are going at it over interest rates and such, and interest rates being high and having higher borrowing costs makes it challenging to do certain things that the government wants to do. Then there's also a lot of talk about QE, being set up for QE to start again, so the expansion of the money supply. But there also looks like there's a battle to keep like the U.S. hegemony intact, and this is like very different than like the 70s, where we had a lower debt to GDP, we had lower debt, lower deficits and such, and so now we're like at this point where it seems like people are trying to protect their capital, and the Eastern retail folks, I mean, they get this. Like, they've been getting this for like centuries, right? It's like the folks in the West are like more financialized and such, and we're used to these, other assets not owning and holding real wealth. And so, just curious in your perspective on that, the protection of your capital.
Be true at the same time.
Yeah. What if someone's starting at zero? Should they be focused on getting off zero? I mean, I think my nephew the other day, he bought his first gram of gold, and so he was excited and such, but he was at zero, right? And so it's like, okay, all right, nephew, let me walk you through how to buy it, blah blah blah. A lot of people are at zero, and so I don't know if they should be worried about, could we get a price drop, at this point, because every risk as of why people are buying the gold, why the institutions are buying the gold, why the central banks are buying the gold. None of those risks has been alleviated. And like I mentioned earlier, this is different than the 70s. The 70s, like our debt to GDP was way lower. We could still come out as a global hegemon, especially, interest rates were high, central banks started dumping their gold for bonds, right? Do I see that happening in any time in the near future or whatnot? No, like I think the risks are still there. And so if you're at zero, I think that people should be, considering that and, purchasing regardless of where the price is today.
Absolutely. And you're that cool uncle, huh? Everyone's got a cool uncle, but yeah, I mean, I think save your bigger threat is saving your money in dollars, and we all have the ability to save. When I started this company, I tell this story all the time. I was 19 years old with my father, and he told me the only rule would be to buy something every 2 weeks. I don't care if it's 1 ounce of silver, he would say to me. Of course, when I started this company, silver was $4 an ounce, so it was a lot easier to do that back then. In the 90s, early 90s, $3-4 an ounce, I remember. But even still, 1 ounce of silver every 2 weeks, you'll be surprised what the laws of compounding do. I mean, it's like if you work out to get in shape, you don't go really hard for 1 week and think it's done. You go on a religious, methodical schedule. The same thing is true about paying yourself first and getting ahead. And you don't have to do everything all at once, but you have to start. Every journey starts with the first step. Get as metaphorical as you want, but absolutely. And it teaches you, how to pay yourself first. I don't know about you, Daryl, but you're not 17 anymore, but how fast did it take to get from 17 to where you are? I'm 55. It feels like I'm still 19. Like, how the hell did that happen? And time catches up with us all. So you wake up one day and say, man, I should have saved. Well, it's not. I mean, your nephew has time on his side. Yes, the market has moved much higher, but so what? Find a way. If you have a job, you can probably find a way to spend $80 every 2 weeks. So, what does that amount to? What's that? $5 a day, kind of? $6 a day? I'm not trying to be less than empathetic. I mean, not everyone is in the same financial position, but if you don't prioritize your future self, time catches up with us all. And so by paying yourself first, by forcing yourself to save, and look, let's be honest, selling gold and silver is very easy, but it's not as easy as pushing a button, not as easy as giving a Visa card or using your Apple Pay. So it lends itself to savings. And I don't know, I think that being at zero right now is a bigger threat to me than being overweight. I don't know how you would be overweight in gold and silver right now unless it represented everything you owned, but even still, I'd rather take that position than having everything I own in U.S. dollars, which have much bigger problems inherently, I think, than does a position in gold and silver, which has been wealth for 6,000 years. Yeah.
I mean, I could confidently say probably the majority of people, at least in the West, they can buy a silver dime. They can buy a Roosevelt dime. They can buy a gold back, right? And so I think that, it may cause some sacrifices. Maybe you sacrifice the Netflix subscription for a month or whatever the case may be, right? But I think that folks can get off zero.
Well, a silver dime right now is worth about $5 or so melt value. That's a good point. So yeah, you could. And you can. That's how you start. And by the time you get to be 55 years old, well, holy crap, look at all that you put away every single 2 weeks. For 2 weeks, there's 52 weeks in a year, so you're making 25, 26 purchases a year, and over time, that adds up.
Mm-hmm. Yeah, for sure. And, I'm thinking of, like, longer-term, time horizons. Like, you mentioned, like, in the early 2000s, silver was $3-4 an ounce. So for me, like, even though I've been stacking since about 2020, I'm looking at, okay, 20 years from now, where's silver at? Especially with the amount of debt deficits and such that that we see around us, the amount of into money supply that is being created, interest rates dropping, QE. If we have another crisis, the floodgates come open with QE and such. And so, I think that 20 years from now, the prices could be significantly higher than where they are today. And so
the prices of everything in dollar terms will be.
The speech you just heard focuses on silver as the pressure point in a fragile monetary and commodity system. What deserves attention now is not the rhetoric, but the confirmation signals accumulating quietly across U.S. markets, regulatory filings, supply chains, and geopolitical behavior. These signals suggest that silver is no longer merely a speculative asset or an inflation hedge, but a stress indicator, one that exposes the limits of paper-based markets and the declining credibility of financial intermediaries. In the United States, the most important development is not price action, but behavior. Over the past 2 years, participants connected to the futures market have increasingly chosen delivery over rollover, particularly on the silver contract. That trend matters because the futures market was never designed for widespread physical settlement. It exists to provide liquidity and price discovery, not to warehouse metal for industrial users or institutions. When delivery volumes rise persistently, it indicates mistrust, specifically mistrust in the ability of counterparties to honor claims in a crisis. The surge in delivery requests at COMEX is therefore not a technical anomaly. It is a vote of no confidence in financial abstraction. This shift coincides with a broader reclassification of silver inside U.S. policy circles. In recent years, silver has been formally recognized as a critical input for advanced manufacturing, renewable energy, defense electronics, and medical technologies. While this classification does not grab headlines like oil or rare earths, it has real consequences. Critical materials are no longer treated as neutral commodities. They become strategic assets subject to stockpiling, trade controls, and national security review. The United States now consumes far more silver than it produces domestically, leaving supply chains exposed to geopolitical friction and export restrictions. That exposure is already visible. Roughly 70% of global silver production is a byproduct of mining for copper, lead, and zinc. This means silver supply is not price responsive in the way markets assume. Even if silver prices rise significantly, production cannot be ramped up quickly unless base metal mining also expands. At the same time, U.S. infrastructure spending, grid upgrades, and electrification initiatives are increasing silver intensity per unit of output. Solar panels, electric vehicles, data centers, and military electronics all rely on silver's unmatched conductivity. The result is a structural squeeze. Demand is policy-driven and accelerating, while supply is geologically and economically constrained. What is new and underappreciated is how this supply reality collides with the structure of U.S. financial markets. The paper silver market is many multiples larger than the available above-ground physical stock. This leverage was sustainable only as long as most participants accepted cash settlement and trusted that physical delivery was a formality. That trust is eroding. Institutions are increasingly unwilling to hold unallocated metal claims or exchange-traded proxies without clear title. This mirrors a pattern seen previously in other markets where confidence failed before price signals adjusted. The United States has historical experience with this dynamic. In the late 1960s, pressure on U.S. gold reserves forced the collapse of the London gold pool, leading ultimately to the end of the gold standard. What is different today is speed and scale. Financial claims now move at digital velocity, while physical commodities move at the speed of ships, refineries, and mines. When confidence breaks, markets reprice violently because the adjustment cannot occur gradually. This matters for the dollar because the U.S. currency is no longer backed by convertibility, but by credibility. That credibility rests on the assumption that U.S. institutions can always provide liquidity without consequence. Yet the post-2020 expansion of deficits, combined with persistent inflation in non-discretionary goods, has changed investor behavior. Assets are not rising because they are becoming more valuable. They are rising because the unit of measurement is weakening. Silver, in this context, is not going up. The dollar is buying less claim on real resources. Central banks understand this, even if public messaging avoids the implication. While the Federal Reserve focuses on interest rates, global monetary authorities are diversifying reserves away from dollar-denominated assets. Silver does not sit in central bank vaults the way gold does, but it plays a parallel role in private balance sheets and industrial inventories. When sanctions are used as policy tools and access to payment systems becomes conditional, physical assets regain importance precisely because they exist outside digital permission structures. In the US, this reality collides with domestic politics. Inflation has become a trust issue rather than a technical one. Households do not need CPI reports to tell them purchasing power is eroding. They experience it in housing, insurance, healthcare, and energy. This erosion undermines confidence in institutional assurances that inflation is transitory or contained. As trust fades, behavior changes. People and institutions seek assets that cannot be diluted by policy decisions made elsewhere. Silver sits at the intersection of this shift. It is small enough that incremental demand overwhelms supply, yet essential enough that substitution is limited. Unlike gold, which is primarily monetary, silver is consumed. Every ounce diverted into long-term holding tightens future availability. This creates a reflexive loop. The more silver is treated as a monetary hedge, the scarcer it becomes for industry, forcing higher prices to ration demand. What has changed since earlier cycles is transparency. Inventories are tracked daily, supply chains are scrutinized, and delivery failures cannot be quietly papered over. If a major participant were unable or unwilling to deliver physical silver, the impact would not be confined to commodity traders. It would raise questions about clearing mechanisms, collateral adequacy, and systemic risk. In a highly leveraged financial system, such questions spread quickly. The U.S. response so far has been to rely on financial stability tools developed after 2008: liquidity facilities, backstops, and emergency programs. These tools can stabilize prices, but they cannot manufacture physical metal. Liquidity solves confidence problems only when the underlying asset exists in sufficient quantity. When scarcity is real, liquidity merely changes who bears the cost. Looking forward, the likely outcome is not a dramatic overnight failure, but a gradual repricing. Silver may not move smoothly, it rarely does, but the long-term trajectory reflects fundamentals that paper markets cannot suppress indefinitely. For investors, the relevant question is not timing the peak, but understanding the regime shift. In a world where assets inflate in dollars but deflate in real terms, preservation of purchasing power becomes the primary objective. From a journalistic standpoint, the silver story is not about speculation or fear. It is about accounting. It is about reconciling the number of claims with the quantity of material, and reconciling policy narratives with lived experience. The United States is navigating a transition from abundance financed by trust to scarcity managed by price. Silver, because of its dual role as money and material, reveals that transition earlier than most assets. History suggests that such moments are recognized clearly only in retrospect. For now, the evidence accumulates quietly. Rising delivery demands, tightening inventories, strategic reclassification, and shifting behavior. None of these alone is decisive. Together they form a pattern that is difficult to ignore. Silver is not the cause of the system's strain. It is the mirror reflecting it.